This video will explain the DuPont analysis. The DuPont analysis breaks down return on equity into three parts. The analysis enables an analyst to understand the source of superior or inferior return by comparison with companies in similar industries or between industries.
With the use of the DuPont formula, return on equity can be broken down into three different components: profit margin, asset turnover, and financial leverage. Profit margin can be calculated by dividing profit by sales. Profit margin indicates how much you are generating for every dollar of revenue. Asset turnover can be calculated by dividing sales by assets. It indicates how much you generate for each dollar of assets that you have. It is important to remember that there is a lot that goes into this ratio. Your inventory turns may be very high, but you may also be managing your property, plant, and equipment inefficiently. It indicates the efficiency of a company's use of its assets in generating sales revenue. It also indicates the pricing strategy. Companies with low profit margins tend to have high inventory turnover, and companies with high profit margins generally indicate low inventory turnover. A low asset turnover does not necessarily indicate poor financial performance, because if a company is sitting on a lot of cash, such as Apple or Google, the asset turnover will appear to be low. Financial leverage can be calculated by dividing assets by equity. A high leverage ratio indicates more debt financing and less equity financing. Utilizing more debt can certainly be risky. There's a high potential for return on equity, indicating the notion of high risk and high return, because if you do not perform, you are still indebted to your debt holders. If you disregard the financial leverage ratio, then you can calculate the return on assets, which allows you to examine how the firm operates while excluding financing activities. The return on assets assists in comparing companies that use different financing strategies.
Now let's apply what we know about the DuPont formula to a real-life example using 2011 financial data of Nike and Under Armour. Looking at Nike's 2011 profit margin of 10.22%, it is almost 4% higher than Under Armour's 6.58% profit margin. However, Under Armour's 1.6 asset turnover ratio is higher than that of Nike's 1.39. Based on this information, it appears that Nike is operating under a more premium price strategy in comparison to their competitors. This is exemplified by Nike's higher profit margin and lower asset turnover. Now we will compare Nike's financial leverage to that of Under Armour. Nike's financial leverage ratio is 1.52, and Under Armour's is slightly lower at 1.44. This indicates that Nike utilizes more debt financing than Under Armour. Looking at Nike's return on assets, they have almost a 4% higher return than Under Armour. Nike is making roughly 14 cents on every dollar of assets that they own, as opposed to Under Armour, which is making 10 cents on every dollar of assets that they own. Finally, comparing Nike's return on equity to that of Under Armour, Nike's ROE is almost 6% higher. Now we will further analyze what these differences in ratios indicate.
While it appears as though Nike is a better investment than Under Armour on a return on equity basis, some differences between the companies needs to be noted. While Nike does have a higher ROE than Under Armour, one needs to remember that Nike uses more leverage to fund its operations. Because of the higher use of leverage, Nike has less equity to distribute its net income across, reflecting a higher return on equity value compared to Under Armour. Overall though, Nike is more efficient at implementing its premium priced, lower turnover strategy than Under Armour's low cost price, higher turnover strategy.
Thank you for watching our analysis on the DuPont formula. We chose to break down the financials of Nike and Under Armour due to their similar product offerings, competition in the same industry, and because we were all interested in their performance. But it was critical for us to demonstrate to the audience that the DuPont formula was important because it can be hard to determine just how good a company is based simply by examining their numbers. As you can see, by looking at the financial data for both Nike and Under Armour, Nike appears to be much larger and able to generate far greater revenue. Therefore, one might assume that Nike is more financially stable and healthy than competitors such as Under Armour. However, DuPont Formula analysis provides a more accurate representation of the information. This can be very overwhelming. Additionally, it can be very misleading when looking simply at the company's ROE because, as we mentioned, it is not always the best indicator. This is why it is best to break down the return on equity to its components illustrated to see the company's performance.